I'm feeling lonely. Kate has abandoned me. Or well, she's not here for this episode. She's busy dealing with the end of the semester, of the academic semester, that is. So I figured I'll do what one always does in those cases. Give a call to a friend and open a beer, right? And chat about finance. So I gave a call to Mike Dambra, and Mike just happens to be the Kenneth Colwell Chair of Accounting and Law at the University at Buffalo. And I figured, well, with such an impressive sounding title, Mike must have something interesting to tell us about finance and accounting, right? So jokes aside, Mike is a very smart guy, and I think you will enjoy hearing his perspective. I'm truly excited about this episode. But then, within the first minute of the interview that you're going to hear, Mike goes on record saying, Veljko and I are not friends. So first, my better half abandons me for the holidays, and then my friend goes on record saying, we are not buddies, and now I'm totally depressed for the holidays. Jokes aside, Mike is going to be here with us today to talk about moral hazard in pension bailouts, and I hope you enjoyed this episode. Now, perhaps moral hazard does need a moment of introduction. It's one of those technical sounding terms. It's almost intimidating, and yet its meaning is fairly simple. By the way, I heard somebody recently saying that moral hazard sounds like the title of an action movie set in a French bordello, and I thought that was one of the best definitions of moral hazard that I had heard. But jokes aside, Merriam-Webster defines moral hazard as a situation in which a party is incentivized to risk causing harm because another party is obligated to remedy the consequences of the harm presumably caused. And that's a very complicated way of saying that when somebody else is guaranteeing our losses, our incentives to take risks increase, right? So if you have kids, you probably know how hard it is to remind them to lock their bicycles, right? And if your kid does not lock their bicycle and then it gets stolen and you're the one buying a new one, well, you just encountered moral hazard. Or when people drive a rental car a little bit faster than they would drive their own vehicle, taking a little bit more risk, that's moral hazard in action. And so it's an intimidating term, it's an intimidating word, and yet it's a concept we see in action every day, and we shouldn't be scared of it. And I did a little bit of digging here. I wanted to find when was the term moral hazard first used, and it seems that the first documented usage of the term actually comes from 1867, and Aetna, I'm not sure how one pronounces that, the insurance company published in 1867 this handbook titled Aetna Guide to Fire Insurance, and in it they were specifying that fire insurance coverage would cover losses emanating from what they called natural hazards, and those were described as natural occurrences such as earthquakes, tornadoes, or other natural phenomena, and not cover damages created by what they described or deemed moral hazard. And they described moral hazard here as damages originating from carelessness or fraud, and then they specified actually under carelessness actions such as playing with matches, which I thought was maybe humorous or oddly specific at the very least. But the idea here being that moral hazard aims at describing damages or risks that arise because of changes in human behavior. In modern economics, we attribute the usage of the term moral hazard to Kenneth Arrow. Kenneth Arrow being a Nobel Prize-winning economist who in 1963 published a paper titled Uncertainty and the Welfare Economics of Medical Care. In this seminal work, Kenneth Arrow pointed out that the insured used more healthcare services to treat a given illness than the uninsured. We would consider that a typical example of moral hazard. So if I have health insurance, I might use more services, but also I might actually take more risks. If my car is insured, I might drive a little bit faster. In the world of finance, we have heard a lot about moral hazard recently. After the global financial crisis, there was a lot of talk about whether bank bailouts would subsequently incentivize banks to take on even higher levels of risk. So these ideas behind moral hazard originate from insurance, and a lot of it had to do with medical insurance in particular. Subsequently, we've seen a lot of talk about moral hazard in banking. We know that moral hazard is often politically invoked when discussing welfare and welfare benefits. The idea that providing safety nets to people reduces incentives for people to work. But today, Mike is going to talk to us about moral hazard in a very different context, and that is pension bailouts. We are going to see that over the recent years, there have been a couple of pension bailouts, or bailouts specifically of multi-employer pension plans. These are large pension plans that cover workers across multiple firms that are often associated with unions. And of course, the idea here is, do these bailouts actually lead pension funds to subsequently take on higher levels of risk, or other forms of behavior that Mike will talk to us about? So the main question of the day is going to be, do pension bailouts actually cause moral hazard? This is with Mike Dambra, and I hope you will enjoy this episode and this interview. Welcome to Questions in Finance,
a podcast where we translate academic mumbo-jumbo to answer interesting questions in finance. I'm Kate Holland.
And I'm Veljko Fotak. Kate and I met when we were PhD students at the University of Oklahoma.
Today, we're university professors, and we spend our days teaching and researching companies, markets, and all things related.
Welcome to Questions in Finance. Today we have with us Michael Dambra. Mike is the Kenneth Colwell Chair of Accounting and Law, and he's also an associate professor in a similarly named Department of Accounting and Law, School of Management, University at Buffalo, which makes us colleagues. We are next door. Mike, of course, in the accounting department, and me in finance. Mike and his work have been cited in the Wall Street Journal, in the Financial Times, Bloomberg, Forbes. If you can think of it, he's been there, most likely. But I will say Mike's research spans, right? You've written about pensions, you've written about IPOs, you've written about accounting disclosure. I think if there is a connection, if you will, if there is a theme, right, it's on the economic consequences of regulatory changes. And because of that, I think as a testament to your impact, Mike, I know you've been cited in congressional testimony, you've been cited in SEC regulatory changes, you've been cited in legal blogs, you've been cited by the Treasury. So hats off to you, Mike. And as you can tell, I did read the bio. Anyways, welcome, Mike.
Thanks, buddy. And happy to be here. I'm glad you don't have video because I am blushing. Veljko and I are colleagues. We're not friends. And so this will be an unbiased, open dialogue.
I'm glad you said it. Accounting and finance, cats and dogs, right? Can we be friends? But okay, so the big topic of the day, there is a crisis in pension funding all over the world, but especially in the United States. And you cite some research that finds there is a shortfall of about $6.5 trillion. I know estimates vary, but we know the whole is big, right? The demographics are heading in the wrong direction. Our population is aging, our domestic labor population is shrinking, and we don't know whether we're going to make the right choices in terms of immigration, right? And what's going to happen to our labor pool going forward. So I suspect that whatever problems, whatever stresses we are seeing in this sector, they're just going to get stronger. If you're seeing bailouts, we're probably going to see more bailouts coming forward, where I think your work is extremely timely and important, right? And of course, I'm talking about your work regarding the American Rescue Plan and the Butch Act. This paper on the economic consequences of pension bailouts, evidence from the American Rescue Plan.
This paper was written with two great co-authors, Phil Quinn, who's an associate professor at the University of Washington, and John Wirtz out of Indiana University. And so let me give you some background. Let's go back to the 90s when pension plans in general were overfunded. Market returns were really good. With heavily unionized plans, when plans get overfunded, oftentimes it leads to unions agitating for more benefits because you have excess assets and employers would try to claw those when they could.
Sure.
And so we consider those multi-employer pension plans. And we haven't talked about this yet, Veljko, but I haven't even defined what multi-employer is.
Please.
So multi-employer pension plans are plans where it's going to be multiple plans where all the assets and liabilities are pooled within one organization, one group. When these were set up decades ago, the main benefit was in firms or in industries where there's not a lot of job security, you could leave FedEx and go to UPS and you don't lose your pension. And so it gives you a lot of job mobility. And so this was made for the benefit of the employees and essentially allowing them a little bit more job mobility.
And help me understand, it seems to me like they're associated with unionized sectors, right? Is that correct?
So the way the governance works within a multi-employer plan, they're going to be co-run by an equal representation between firms and unions. So everything is collectively bargained, how much I'm going to contribute in the plan. So the times in the 90s were good. 2000, 2010, we have these big economic shocks. One is the dot-com downfall, and then followed by that, the great financial crisis. A lot of these funds were heavily funded by equity. Market returns were bad. When you have these big shocks, oftentimes the obligations you owe to retirees don't change. The discount rates might, but what you owe to retirees in the future with a big market shock, that liability still exists. And so more aggressive pension plans tended to get in more financial trouble.
So I have to admit that the first thing that surprised me reading your paper was you have interesting history there, right? Nice institutional detail. Is this real? I mean, this fact that these pension funds were actually doing well in the 90s, we know they play games with discount rates, right?
Sure.
Because I'm European, right? And the idea that a pension fund could be solvent is, were they really solvent in the 90s?
They were overfunded, but it's a very fair point. It's according to the rules. And so the way we're going to do rules in these particular funds, the discount rate is oftentimes not measured in what we use as GAAP fair value. You're going to use some estimate. And so the two particular pension plans that are in the most stress in the U.S. are public sector plans and these multi-employer plans, which we focus on. And here, the discount rate is going to be based on the expected return of future assets, which isn't really appropriate. If you read research by Josh Rao out of Stanford and Novi Marks in their seminal JF paper, they argue that these are unrealistic discount rates. So for some background for those non-finance savvy folks, the higher the discount rate is, the lower the present value of future pension liabilities.
So sorry to interrupt you. We got to say this twice, we say it slowly, right? You put a higher discount rate, is that the same as you're projecting higher returns going forward?
That's right. That's right.
And so you need less money now since it's going to generate higher returns later on.
No, that's right. Okay. So what happened with these pension plans after this big market shock, they got in more financial trouble. What we study in this paper are what we refer to as private sector plans. These are plans that are owned by firms. Some of them are publicly traded, some are privately held, but they're in the non-government sector. And so they're manufacturing firms, they're publicly traded firms. You'd have General Electric in the sample. You'd have a lot of the unionized pension plans and airlines.
Mike, this is personal curiosity. Are we in here? Like, are teacher and professors and TIAA, which I think covers a lot of the faculties.
Right.
It sounds like a multi-employee pension plan to me by definition, and yet I don't exactly know.
That's a great question. So we are a multi-employer pension plan, the way that it works with UB, but that's the public sector. And so that's all government plans. What I'm focusing on in this paper are non-governmental firms.
Okay. I did read the paper carefully. Of course.
So the 6.3 trillion you mentioned, so what Josh Rao and Novi Marks do there in their seminal paper is they take more realistic discount rates. Instead of using these expected returns, they're actually going to look at risk-free rates because they argue that a lot of this debt is essentially risk-free. And so these lower discount rates, higher obligations, the $6.3 trillion is based on public sector plans. And so New York State would be in there. And so we'd be in that group.
Discounting it back, the risk-free rate makes sense. You got to pay this stuff. It's a guarantee that you have to pay it. And yet, if you're thinking about it in terms of this is generating returns, you're not investing it in risk-free instruments.
You aren't, no.
What is my fallacy?
There's a disconnect, right? Because you're thinking about not the returns of the plan assets. These are discount rates on the future liabilities. And so it's how likely is it that they're going to have to pay these obligations?
So the risk-free rate does make sense.
Yeah.
Fair.
But what we'd see under GAAP for liabilities is more like bond yields. And GAAP rules are going to be market value of AAA rated bonds.
And I've actually seen pension funds use numbers that were a lot higher even than that. Are these multi-employee pension plans somehow actually not the worst offenders? Because I've heard discussion about pension plans that were as high as 8, 9, 10%, right?
Right.
Which sounds a lot higher than anything bond-related.
Yeah, no, it's because the public sector and then multi-employer plans, they follow the same approach where they use expected return on plan assets. So if I looked at the average here, it's probably somewhere in the range of 7 to 8.5%.
Oh, okay. Fair enough.
So
that's higher than I thought. Going back to where this conversation started,
Right.
We started by saying in the 90s, these funds were properly funded.
right.
And yet it's not entirely clear what changed, or at least it's not clear to me. What is the big trigger? Why do we have these problems all of a sudden? Because I guess pension fund underfunding can come from firms that are not contributing enough. It can come from the funds that are not performing the way we expected. As far as I can tell, your results are pointing more towards the latter rather than the former.
Particularly in the multi-employer pension plan sector, they tend to be more equity-based.
Okay.
And so they have a little bit more risk. There's been an impetus on liability-driven investment, having more bonds in your holdings. That hasn't really been the case for the multi-employer pension plans. And so I think the shock differentially, these financial crisis shock, the dot-com boom, I think they differentially hit the multi-employers plans, and they've had a hard time catching up.
Makes sense. I know that at least in your paper, you attribute at least some of it to declining union membership, just a lower base.
No, that's right. So anyways, these huge shocks came, and particularly in the multi-employer pension plan sector, horribly underfunded, even with these higher discount rates.
Fair enough.
And in the U.S., there's a backstop. So if private sector pension plans fail, there's a group called the Pension Benefit Guaranty Corporation, and they backstop if a plan goes under. They provide funding. The PBGC, realizing there's a financial crisis, a lot of these multi-employer pension plans failed. And so the PBGC came out in a statement in 2019. They said, there's a high probability we run out of money by 2025. By 2026, it's a near certainty. So the plans are horribly funded. They're going under, and there's some concern that the government won't have the money to back them up. And so there were a couple different legislations, which they coined the Butch-Lewis Act. They tried to pass it in, I believe, 2017. Didn't work out. They tried to pass it in 2019. They couldn't get it through Congress to provide funding. And these original rules that they tried to push were these really underfunded pension plans in the multi-employer sector. We're going to give them a loan that they're going to pay back to the government. So couldn't get consensus in 2017, couldn't get consensus in 2019. In comes 2021. Now we're in a COVID world where there's been a lot of stimulus. And so this plan, this American Rescue Plan Act was being passed under the Biden administration. It was going through Congress. The biggest component of this plan was giving out $1,400 checks to people who were restricted by COVID. So there's some additional COVID-related stimulus funding.
And now you're talking about the overall ARP, right?
That's
It's
right.
the American Rescue Plan.
That's right.
Because the $1,400 checks are not part of Butch-Lewis, right?
No.
Okay. I'm still trying to wrap my head around it. And
Yeah.
so I think that the full name, I had to look it up. It's the Butch-Lewis Emergency Pension Relief Act. And I guess I didn't know who Butch-Lewis was. He was a union organizer, right, that has fought for pensions. And I think that's very telling because to some extent, this is very explicitly pro-union. This is very explicitly, we are giving you a handout, right? And quite a substantial one. And the politics of these, I'll bite my tongue for the moment, but they make my skin crawl a bit.
Yeah. Even though the 2017-2019 acts as proposed, which didn't pass, were at least loans. And so the thought is we loan money to these horribly mismanaged pension plans, and then the pension plan has to pay us back over time. Low interest rate, so not risky, but there was funding that was eventually going to be paid back to the U.S. government. So you're still unsure if this is good policy, but at least it's a loan.
Sure.
So with this American Rescue Plan Act, which is essentially a COVID stimulus bill, on the very back end of the bill, they end up tacking on this money to subsidize these poorly run pension plans that were going to run out of money. And so I think the original projections by the Congressional Budget Office were around $80 billion. And different than the iterations of the earlier suggested pension plan legislation, these were cash bailouts. Not necessarily no strings attached, but there's no loan. And so you provide the money. There's some restrictions on what you can invest in, but it's essentially, here's $80 billion. And the only reason that really got through in 2021 is because we had a unique situation in the U.S. government at the time. We had, for those of you unfamiliar with the way the government works in the United States, you have two legislative bodies, the U.S. Senate and the House of Representatives. They were both majority Democrat. We also had a Democratic president at the time. And so having all those three components, both the executive branch and the legislative branch, essentially controlled by Democrats, made it easier to pass this legislation.
The Biden administration started publishing very flattering reports of the impact of this legislation, sometimes in November, right before the election. And these reports, they start with highlighting no Republican voted for this. It really is pretty shameless the way this looks from the outside, and I look forward to your more educated input.
Right.
But when I was reading about this, it made me angry. And it's not often that I read a finance or accounting paper and it just makes me flat out angry. And I wonder, you're very balanced, right, when you guys are describing this, but what was the feeling that got you to write about it? Were you guys just disgusted by what you were seeing and decided we got to write about this? Or, I mean, what was the impetus here?
So this is a good segue in how I do research and how a lot of us do research. I think really smart researchers can read through the extant literature in finance and accounting. You find holes and then you fill those holes. And that was never my wheelhouse. And so my wheelhouse was more like reading the Wall Street Journal, reading finance blogs, and understanding what's going on in current markets. And this is a one-of-a-kind bailout. This is the first time under ERISA in the past probably 60 years, we've actually just given a cash infusion to a private sector company. So this was a huge regulatory change. And I thought it had impact because the public sector, so where our pension plans are, Veljko, are oftentimes in much worse shape than even these multi-employer pension plans. So I thought this would be predictive. And so the reason I got into it, huge shock, I thought it mattered, and I thought it'd be interesting to study. A lot of times when my research has pressed on these regulatory issues, it's great situations because there's this built-in tension. Some people want the regulation. Sometimes you don't. And in this situation, I was probably more on the don't side. I'm a taxpayer. This is coming out of my money. Veljko, this is coming out of your money to fund what has been horribly managed pension plans by unions and firms. And was I disgusted? Maybe disgust is too strong of a word, but it didn't seem like good fiscal policy to reward bad behavior.
There are some pretty nasty anecdotes behind some of the pension funds that were receiving bailouts here. I think that one of the biggest recipients was I'm drawing a blank now on the name, the one that was associated with Jimmy Hoffa, right? They were buying casinos back in the day. Now they're bankrupt and now we're bailing them out, right? But I have a lot of follow-on questions about that, but I feel like I'm getting a little bit off track here. So let's get out of the way the main findings of the paper, and then we can get into the nuances and the implications.
So what we want to do is we want to look after the passage of the American Rescue Plan Act, which was 2021. What we try to do is follow the money, and we wanted to see if multi-employer pension plans would have revised expectations of future bailouts. So we see this big reward for bad behavior. And so as researchers, as archivalists, we were like, well, this is pretty interesting. I wonder if it's going to change the behavior of the pension plans in this sector. There's a lot of research in the banking sector that say bailouts can affect a whole sector or a whole industry. Well, let's apply this to our setting. And so we have this group of plans that is affected. And so we consider those the multi-employer. So multi-employer pension plans are plans where it's going to be multiple plans where all the assets and liabilities are pooled.
I saw that the numbers are pretty big, right? That same report in November mentions that the Butch Lewis Emergency Pension Relief Act already dispensed $69 billion of assistance to about 1.2 million people, if I remember correctly.
Yeah.
I know I've seen the average, the average plan is 4,000 people on it, which seems pretty large, right? And 1.2 million participants sounds huge, right? And yet the numbers are huge too. I had to do the math a couple of times in my head with the zeros, right? Because I went 69 billion, 1.2 million participants, around $60,000 per participant. And then I went, there's no way. And it is $60,000 per participant. This is a heck of a per capita benefit.
And one of the reasons for that is a lot of these multi-employer pension plans were just so poorly funded.
Sure.
And so what we try to do in the study is we want to isolate a group where their bailout expectations fundamentally change.
Mm-hmm.
So we stay in the multi-employer pension plan sector, but we try to focus on those groups that haven't received a bailout. So when you receive the cash from the U.S. government, there are restrictions on what I can invest in. And so there are limitations. And we thought of the cleanest group, we're like, okay, let's stay in the multi-employer pension plan sector and let's look at the plans that haven't been bailed out and see how they respond.
And that's a bit counterintuitive, right? You're looking at the impact of this legislation, or at least the unintended consequences,
right,
on the funds that were actually excluded or not covered by it, right?
Yeah. Our theoretical prediction was this bailout pop. It really happens and it affects a subset of pension plans. And you're right, we exclude the ones that are already bailed out because their behavior is now strictly monitored by the government. There's restrictions on what they can invest in. There's restrictions on what they can do with the money, how much fees they can make. And so what we wanted to focus on were multi-employer pension plans that didn't receive the cash yet, because we thought that was the cleanest group where expectations would be revised. And then we try to focus on what group is not affected at all by this pension plan. And so we look at single employer pension plans. Those are the more traditional ones. You have one firm, one plan.
Mm-hmm.
There was no bailout there. The funding within the PBGC is really good. They're well-funded plans on average. And we try to understand before and after, how does behavior change for that group that has revised expectations of bailout? So that's the setting. So we're going to look at the 2 years after the passage of the ARP. And then we're going to look at things like, what are they investing in? Where are they investing their assets? Is it going to be in super conservative things like cash, like government debt, or is it going to be more aggressive things like equity, private equity? So we're going to look at their asset allocations.
So you're trying to get a sense of how risky and how aggressive they are, right?
Right. And a lot of this might be even human behavior. If I engage in risk and I lose money on these investments, Uncle Sam is there in the future to bail me out. The one incentive these plans are going to have, even the ones that didn't get bailed out, they're still underfunded. But the incentive for these plans is if I take on more risk and my assets go up, I have to pay less pension contributions, or I have more capital to pay off my pension contributions in the future.
You can just say they're revising their expectation of the likelihood of a bailout coming into the future.
Right.
So they take on a little bit more risk, right?
Yeah, no, that's right.
But, I know how I feel right now about paying my kids' college fees, right?
Yep.
There have been a couple of bailouts, right, of people that took student loans, right?
100%.
And right now I feel like an idiot for paying for college in the first place. So I'm wondering if there's something similar here with these pension funds going, we were the well-behaved ones. We didn't overpay ourselves. We didn't boost our earnings by taking outside risks. And there's no reward, right? Or rather, the rewards are going to the unethical, unprofessional ones. And so who am I being an idiot for being well-governed, right? But I guess it leads us to the same spot, right?
Yeah,
But with a different nuance.
We end up in the same spot. And you can see that even in the student loan sector now, right? The repayment rates have gone down because there's some expectation of future government intervention. And so, yeah, what we're seeing now is very similar to what we see in the pension sector. So the first thing we look at is asset allocations. And what we find is the group, these multi-employer pension plans, after the ARP, tend to engage in, they have riskier asset holdings. What I mean by riskier, things like investment in equity, in particular investment in private equity. Yeah. That goes up relative to single employer plans, which don't have this revised expectation after the ARP. So that's the first main finding, that there's an uptick in risk that wasn't there before.
This part of your findings, I don't know how to feel about managers, because in some sense I'm going, well, you're taking advantage of taxpayers to some extent, right?
Yeah.
And yet this sounds consistent with your fiduciary duty to the pension fund member, right? I mean,
right.
All else equal, a high probability of a bailout, I should take a little bit more risk, even if I'm objectively maximizing the objective function of my savers, right? Or my pension fund members. And so here if there is any adverse consequences, I'm tempted to blame the regulators more than I'm tempted to blame the fund managers that are taking advantage of it, right?
Yeah.
But I know you have another layer of findings that seems to cast a little bit of a less positive light on managers, right?
Well, let's stick on that point, because I think it's super interesting, because this paper is essentially fundamentally about moral hazard. Mm-hmm. Moral hazard being you're going to act in such a way that a party that was not really involved in that decision bears the costs. And here's the taxpayers, as you said. So on that point, what are these managers acting in terms of maximizing or just good fiduciary duty? And I think I'd have two things I want to quibble with you about that, and I'd love your opinion. On the equity side, I would say I wholeheartedly agree that with this revised expectation of a future bailout, then, well, maybe I should take a lot more risk, as you said. But what's interesting about our study is when we really get into the nuts and bolts, where you see the biggest increases on the PE side. Mm-hmm. You're going to know from the finance literature that PE returns, typically they don't outperform, but one thing they clearly do is cost more. And so investment fees go up a lot. And so if that's benefiting retirees, I'm not sure, because there's a pool of money and there's now a bigger slice being paid out to investment managers. Mm-hmm. So that's not great. And then the second thing that are the managers acting in the way to maximize fiduciary duty, I'm not sure, because when you're engaging in more risk and the bottom falls out, we don't know, are we going to have a purely Democratic-led House, Senate, and President? This was a very unique situation. It was an era in the United States where there's a lot of free money through COVID stimulus. Mm-hmm. So even though they have revised expectation of future bailouts, it's still not 100%. In particular, if these plans underperform again, are we really going to pay them again? I really don't know.
And yet, in some sense, Mike, all else equal, the probability is a little bit higher, right?
Yep, and that's right.
And I do feel like you are trying to have your lunch needed too, right? Because on one side, you're saying there's a higher expectation of bailouts, which creates moral hazard, right? But okay, fair enough. I do understand when you're saying this might not ultimately be in their own self-interest. And you're saying they're increasing potentially their own fees and revenues to the financial sector by allocating to private equity. But I think you have also some other results that speak directly to fees, right?
Yeah, yep, that's right. So we also find that fees go up. And so fees are going to be a mix of administrative fees. And so those are for the sponsors of the plan, and also investment fees. And we see that multi-employer plans, their fees go up relative to single employer plans after the passage of the ARP.
Fair enough.
I think the clearest evidence that we have of moral hazard is there's great data. This data it's all publicly available. These are called the Form 5500. And there's a box. It's an indicator variable, or a 0-1, that says, did these pension plans change their pension plan agreement such that benefits increased? Yes, no. Did these plans change their agreement such that benefits decreased? And so there's a couple boxes, and what we find, multi-employer plans after the ARP are more likely to increase benefits. as compared to single employer plans after the rule.
Which again goes back to that fiduciary duty, right?
We don't have to quibble on whether the managers are executing their duty. As empiricists, we just test things. We want to see what happened after this massive regulatory change. And this is what we find, and we find it interesting. Whether or not it's, good behavior on the fiduciary side, I think you and I will argue about, which is totally fine. Whether this is good for taxpayers, we bear the brunt of this, Veljko, and that's frustrating because, as you said, we're rewarding bad behavior.
Yeah, I'm not going to quibble with that part of your findings, certainly. I find the details of what you do in your analysis extremely interesting and extremely intriguing. And I find the results very convincing. There are a couple of things, if I were to nitpick here. One of the things that keeps going through my mind when I look at this paper is I still don't know why some of these plans are getting aid and some are not. There is a hint there that there is an application process.
Yep.
So they do have to actually apply for SFA.
Right.
But I'm still stuck into, is there something fundamentally different about the multi-employee pension plans that do not apply for aid and do not receive it? I constantly have this lingering question, and I know you do a lot statistically to dispel these doubts with parallel trends, assumptions, and whatnot.
Yeah, no, that's good. You're a good researcher, Veljko, because that's probably the number one question is, is it fundamentals or are just these multi-employer pension plans so different? Let's start with the first question. It's how do we get this funding?
Sure.
The way it got set up, the guarantor, the Pension Benefit Guaranty Corporation, took applications. And the applications, whether or not I get what's referred to as special financial assistance, it's going to be dictated by how well funded your pension plan is. Basically, am I going to run out of money within the next 30 years as a base of the criteria? And so the way that the government dictated, there's a couple different rules, but the hard and fast rules are dictated by what was your pension status. They tried to prevent firms from manipulating this stuff. And so the rule change happened in 2021. You're going to use criteria from 2019. What are your pension assets? What are your pension liabilities?
Mm-hmm.
And so if your funding ratio was below a certain level, meaning I'm going to take your pension assets, divide it by the present value of your pension liabilities. If that's below a certain threshold, you can become eligible for special financial assistance.
So you can't all of a sudden just lower your discount rate and make yourself look worse.
No.
But you do have some findings later on in the paper where they do exactly that.
So, Kate, I'm glad you read the paper so thoroughly, Veljko.
Actually, Kate sent me some notes.
Okay, cool.
Yeah,
Kate
read the paper very carefully, yes.
So the only thing where you have a little bit of flexibility is on your discount rates. And so there is a little bit of flexibility, and that's your discount rate here is going to be based on your expected return on plan assets. And so there are two criteria in which if you basically lower your discount rate, you can get below one of these key funding thresholds. But that's only available for a handful of pension plans. You have to be close to one of these funding thresholds. The time to apply for special financial assistance is through the end of, I think they can apply through 2025.
Oh, okay.
So the majority of plans are sort of locked in where they either get benefits or they don't. There's a couple criteria that are going to be based on your funding ratio. And for those plans that have some wiggle room, we're talking basis points. We see some evidence of those plans are really close to becoming eligible to press their discount rates downward.
No, that's really fascinating. But I guess one of the reasons why I keep coming back to why some of these plans are getting aid and some are not is because when Kate read your paper carefully, we noticed that the plans that actually do receive bailouts, the SFA, they actually are not increasing risky behavior. If anything, they seem to be buying more bonds and they don't increase administrative fees. It's the one that are not receiving aid that are engaging into this kind of behavior, right? So, to play devil's advocate here, are you being a little bit unfair here? Because the actual recipients of the program are behaving well. And is there a problem here that the program is discretionary? In a sense, I remember a long time ago trying to write a paper about TARP, the Troubled Asset Relief Program, right, following 2007, 2009. And one of the controversial provisions there was every bank had to accept it, right? Because you didn't want to have these kind of moral hazard incentives on the ones that didn't. Now, as you already hinted at earlier, pensions and banks are not the same, and there are a lot more collective action problems with banks and whatnot. And yet, it does strike me, is one of the lessons, if the moral hazard problems here are particularly hitting the funds that are not receiving aid, would a better approach have been inject cash in every single multi-employee pension plan?
Oh, interesting. So the one thing I would say that the government should pat their back on, you make a very salient observation that those plans that receive the bailout funding seem to be acting better.
Sure.
One of the reasons you see that is because they're contractually obligated to. So when you get this funding, you have to put 2/3 of it into safe debt-based securities. And so they're not allowed to invest in all the equity. There's also maximums where they can charge for administrative fees. And so I think there is some good congressional input that came out of it, that those that got funding were limited in the ways they can use those funds. And so I think from a legislative standpoint, those were good additions to the bill, but it's also difficult to interpret that those that are getting funding are behaving better. Yeah, because they have to, not because they want to, but there are some regulatory tweaks in there that I think sort of force better behavior.
I know that I've been reading a lot of commentary on this, and a lot of this commentary is political. This is a political act, after all. And some of this commentary was faulting the Biden administration for injecting money without fixing the problem.
Right.
And my first instinct was, yeah, that's exactly what this feels like, right? But yet, a more careful reading of your findings leaves me a little bit more nuanced here, because the funds that are actually taking the money are being asked to change behavior, and they do seem to be changing behavior in a positive direction, right? And again, stop me if you don't want to go there yet, but at some point in this conversation, I would love to ask you, I guess this is a joint question. The first part is, are bailouts necessary? And the second one is this a criticism of bailouts in general? Is this a criticism of this particular bailout program? I mean, what do I take away from here, right? And maybe we can step back a moment. When I read your paper, I find that, you're staying nuanced, but I quote you once in the paper where you called ARP a firestorm of moral hazard, where sponsors, administrators, and union leaders engaged in numerous risk shifting and self-serving behaviors, right? But I know I like strong statements, so no, I was happy to find that in there. But so the take away here is a bailout creates moral hazard.
That's
right.
Yep.
And I don't want to take away anything from your contribution in the sense this is an important program, it's a big one, your evidence is strong and well identified. Where I have a little bit more questions really is, what are the alternatives? Is moral hazard just inevitable and we just have to find a way to design a bailout that generates the least amount of moral hazard? Or what am I taking away from this? Bailout is a better way of doing it?
Probably the latter. What we thought was interesting about this sector, independent of what you've seen for banking, it's the first time ever in the pension sector. And there's another bailout potentially coming, which is what sort of Josh Rao had forewarned about on the public sector. So you have plans like Chicago, and these are trillions of dollars. This unusual subset of plans, multi-employer private sector, it's probably a sixth of the size, but it's a good microcosm of what maybe we can expect from behavior in the future. And so you're right that for the plans that got bailed out, so far we have not seen adverse behavior. But anecdotally, we're still seeing bankruptcies. Yellow is a major transportation company. They went bankrupt. They got funding. And so what our quibble with this bailout, it's only a temporary fix. It gives these plans 30 years of capital. And so you essentially kick the can down the road for the next generation. So in 30 years, they're going to run out of funding. And so it's a temporary fix, though maybe if it's a medium fix, right? It's not short term, it's not long term, it's a medium fix.
even fix feels generous, but more of a fix is a plug, right?
Yeah,
I mean, you're not
that's
really
right.
fixing anything. You're just bailing a little bit of water. It's still leaking at the same speed in some sense.
And we thought it was going to be different. One of the reasons we thought about what have we seen in the banking sector, generally you've seen bailouts increase moral hazard.
Sure.
And so we thought there's two big differences in the pension sector that you don't see in the banking sector. One, you have unions involved. And it's a little bit different. We weren't sure if the unions would be as risk-seeking. And so we thought they might create a hedge against increasing equity allocations, increasing PE allocations. Ex ante in our hypothesis. That wasn't the case. It seems like the unions were okay with it, which was a surprise to us. And second, there's very strict fiduciary responsibilities. And so I think that was one of the criteria that I thought distinguished us is there's very strict under these ERISA regs about how much I can contribute. You need to keep a balanced asset allocation portfolio. You need to maximize returns, not take on excess risk, and then minimize costs. And we don't see a minimization of costs for sure because we see administrative fees. Their fees go up. And so I think those were the two distinguishing criteria that we thought were interesting. But it's fair to give us a debate on, is this what you expected? I think when we've presented this paper in workshops, what's cool about this paper is we get two very distinct viewpoints. We have some audience members that say, well, Mike, this is obvious. We've seen this in the banking sector. And then the person next to them says, there's no way this increases moral hazard. And so I think from the audience, we've been happy with that.
I was trying to wrap my head around it too. And it's such a very different take on moral hazard, right? Because when you're thinking about the banking sector, you're always thinking about depositors making their own decisions and how you avoid bank runs. And here with these pension plans, the participants are captive. You're not expecting the participants to bail out and walk to a better fund because it's better funded. They just don't have that option. It almost feels like the more you know about this literature, the less it feels the same, right?
Yeah.
At first you go, yeah, of course, moral hazard, both sides, right? And yet the more you think about it, the more you realize that the mechanisms for moral hazard that are there in the banking sector are not here, right?
Yeah, and one more thing on that argument, when I was talking to a bank researcher, they're like, well, Mike, this is nothing like banking because when you see bailouts in the bank sector, it's related to systemic risks. There's not systemic risk here. This is a sort of subset of retirees that aren't getting money. His argument was this bailout is more exogenous than what we see in the banking sector because it's not systemic. And then there's a lower probability, maybe I'm speaking on both ends here, but there's not a guarantee of this happening in the future, particularly because it was sort of thrown into a COVID stimulus bill. Will the next pension bailout look like this? Probably not. This was a very unique time in the United States.
But okay, to go back to what's the alternative, right?
Right.
So $69 billion, 1.2 million participants, $60,000 per participant. I'm going to wager that if you had actually polled people and asked, do you want us to recapitalize your pension fund or to send you a check of $60,000? I suspect most people would have taken the $60,000 check, right?
That's right. That's right.
Do you guys have a view on this? This is a massive amount of money. Would it be a better idea to just write a check to people and let them manage their own pension funds? Why are we bailing out these pension funds instead of bailing out people?
No, that's a very good point. So when you read through some of the congressional testimony in the Bush-Lewis Act, some of the actuaries and some of the pension experts were saying, well, you know, a bailout fundamentally shifts incentives. And so if we're bailing out but not fixing the problem, you're going to have these issues. And so there's other things that didn't change that don't exist in the multi-employer group that exist in the single employer. For instance, under the single employer group, you have to make contributions based on a function of your underfunding. And so basically you take the underfunding, loosely speaking, you divide it by 7. And there's a tranche. You have to pay that. So you're forced to play catch up. That doesn't exist in the multi-employer pension plan sector. The rules are that it has to be contractually negotiated between the union and the firm such that the plan eventually becomes fully funded.
To me, that sounds like unions have a lot of lobbying power and they were able to extract benefits. I'm not sure about the welfare optimality, right? But which goes back to the same question of, at this point, why are we bailing them out again? I really got stuck in this Labor Department report published on November 1st, right, of 2024, which again, I thought that the timing was very suspicious, right? You have this thing going on for a couple of years,
Right.
and heading into an election, you're highlighting the benefits, right? But the report starts with actually anecdotes. They're talking about John Smith, who couldn't afford the medical operation, and Joe Doe, who didn't have enough money to send their kids to school, right? And so they're making this very personal. They're putting a face to this, and they're constantly portraying this whole plan as being something given to the people, right? We are bailing out people, right?
Yeah.
And yet, in the back of my mind, there is another spin-off. You're bailing out firms, or rather, you're allowing firms to underfund pension plans. Nowhere in these White House and Labor Department reports is there any hint to the fact that there are benefits accruing here to employers. It's all about the little guy, right?
Right.
And okay, I get the political spin, but I'm still struggling with wrapping my head around this. Who's the big winner here, Mike? Is it the workers that are clearly the recapitalization of the funds is helping them out,
Yeah.
right? Or is it the firms that are now going forward going to keep underfunding these funds? And you're hinting at a Miller and Modigliani equilibrium here, right?
Yep.
Where employers are going to expect a higher level of pay if they know the pension fund is underfunded. And of course, that requires some heroic assumptions about discount rates
Right.
and full transparency, full understanding. But even if we assume all of these, I don't think, that's the way people think. How did you guys think? I mean, is this a benefit to workers? Is this a benefit to firms?
That's great questions. When we put together these winner and loser columns,
Sure.
I would say clear winners would be retirees, right? They were going to
Fair
run
enough.
out of money. There's no money to back it up in Congress, right? And so clearly the workers benefited, maybe not as much as your alternative solution of giving them checks. Maybe they would have been better off. There's no increase in fees. There's less risk, right? They just get cash. And so I think workers won to some extent. I think firms won to some extent because they got free money from the government. I mean, that people like free. I like free money. But the losers are pretty interesting. I think the losers, for sure, are taxpayers, number one. So we have some of our tax money being given to bad actors. I
Sure.
don't think that's great. And the second interesting loser, I think, is the political party. What was super interesting about this, and what I find still fascinating, this was essentially a Democratic bill, $80 billion. The biggest recipient of this funding were Teamsters. Okay, so
Sure.
Teamsters were one of the biggest bailouts. They did not endorse Kamala Harris this past political cycle.
I love the fact that you're going. I was going to wonder if you were going to be willing to go there. And because I had a whole list of questions about this.
No,
right?
it's fascinating, right? They paid essentially for votes and
Correct.
didn't get them.
And they paid a lot.
Yes.
This is a $60,000 per vote, right? And I literally had that question in front of me here, right? It doesn't seem to have worked.
No, but it depends.
Should Joe Biden have been a little bit smarter and signed those checks with his name, right?
Yeah, maybe that political process, maybe you're right, Veljko. If Biden just paid the workers direct cash rather than it coming from this weird regulatory firm-based pension payment,
Sure.
maybe it would have worked out better for the political party, because it doesn't seem like the Democratic Party got an ROI from this hugely costly bailout.
I mean, I think you could also argue that there still would have been some moral hazard if they had done that. And
Yeah.
yet, perhaps moral hazard from the point of view of the firm, that feels like they can still underfund.
Mhm.
And yet, if I'm a fund administrator and the cash is going straight to people, that's not creating moral hazard to me, right? So at least you would have avoided that shift to riskier investments in many ways, right? So, yeah, it seems like it was a bit clumsy in that way. But I guess there is also a scale issue here that we really haven't spoken about. We are identifying the problem in trillions.
Mm-hmm.
We are talking about solutions in billions, right?
Yeah.
I know how the Labor Department report highlighted specific states, and they kept making a big deal about how big one impact this was in Pennsylvania, right? Which was, of course, a very contested state. Right. I think they highlighted that Pennsylvania had 65,000 recipients, and they kept highlighting that in press reports and whatnot. Since we are at this hyper-political part of the conversation, let me ask you about this. This is the part that did strike me. I'm not going to put words into your mouth, but I think that you lean a little bit more right tonight, right?
I think that's fair, yeah.
And I don't even know how to identify myself politically, because I feel like I don't belong to either party in the United States. And yet I do feel like I'm a little bit left of center nowadays. And I recently wrote a paper on trade tariff exemptions that was extremely critical of what the Trump administration did in 2018, 2019 on the Chinese tariffs. Effectively, what we are showing in our paper is that firms that contributed to Republican politicians were actually a lot more likely to get exemptions under this Republican administration. Firms that contributed to Democrats were less likely to get exemptions, right? So a paper that's somehow critical of behavior of the Trump administration, right?
Yep.
And I strongly believe in the depth of my heart that I'm trying to objectively present facts, right?
Yep.
And I do believe that the facts that we're presenting in that paper are absolutely correct and as much as possible free of bias, right? You are now writing a paper about something bad that happened under the Democrat administration. And I know you as a researcher. I know your heart is at. I know that you are free of bias when you are analyzing your data. And yet, are we both guilty of editorializing in choosing the stuff that we work on? And are you in any way, shape, or form second-guessing yourself because of that?
Yeah, this is a fair point. When you do a lot of research on regulatory changes,
sure,
you try to come in unbiased, but you try to pick areas of interest that are maybe not politically sensitive, but of interest to the business press. And so I think I found different regulations. I've done a lot of research on the Jobs Act. That was an Obama act that was successful. We find evidence that it increased IPOs. And so I found some evidence that deregulation from Democrats has been a good thing. And so we've also done research on SPACs. Our research on SPACs say maybe SPACs weren't all that great. Mm-hmm. And so I've done several different research. You and I have been doing research long enough where we're going to do studies on Democratic regimes and Republican regimes.
Of course.
So I think the time series makes me less worried about that. You just, your research, like my research, you come up with an interesting question in research design and you just let the data tell the story. And I think that's what we had here.
No, I mean, I appreciate you saying that. And I think that in many ways, that's exactly the same way I would have answered that question if somebody, asked me. I'm genuinely becoming a little bit more self-conscious about my own biases in some sense, right? God knows that when you start doing research about, as you say, regulatory changes, unintended consequences of politics, you do find dirt on both sides, right?
Sure.
And yet it's interesting that in our objectivity, you have ended up with a paper critical of a left-wing administration, and I have ended up with a paper critical of a right-wing administration. Now, you have a better defense to it. You're saying you have other work on the other side of the spectrum. I don't even have that defense. I am starting to second-guess myself. You stay as objective as possible in the treatment of the topic, and yet our time is limited, and there is a subjectivity in the choice of topic you cover. And that's where I am second-guessing my own biases. Let me just put it that way. But I guess a little bit of soul-searching is always going to help.
But let's talk a little bit bigger. There's a publication bias in the field where, in a couple different ways. Number one, it's really hard to publish null results. And it's just the way it is. And so if we did this study and we didn't find a shift in moral hazard, that would just be shelved in our desk or on our databases and it wouldn't be published. And it's a sad state of affairs, but that's sort of the way it works in social sciences, unfortunately. And there's also a bias where you're going to have a hard time publishing things that go against the views of the editor, which are oftentimes randomly assigned to a reviewer. And so if you're doing a paper on gender or diversity and you find that gender or diversity are bad for whatever reason, I don't do studies in those areas, I think that paper would be really hard to publish. And I think some of that is publication bias. And so am I self-conscious about my research topics? I tend not to be. I think tenure sort of protects us on that kind of stuff. So I've never really been worried about it. But I would be absolutely cautious to publish a paper that was extreme. If I found evidence, even if I believed in that evidence, that was extremely controversial, I think that would sort of get me in hot water.
All right. And you don't mean controversial politically?
Right. I mean more socially. I think it's a little harder. The world is so split 50-50 between left and right. And I think you and I are both closer to the center.
Sure.
So those kind of topics, I might get rejected by a biased editor, and that's okay. But I think the next time I submit, maybe I'll get a better shake. But something that's more socially controversial, I think I would be worried about trying to publish.
And yet that's a sad statement about our profession.
Yeah.
Because we should be able to ask the tough questions, right?
Right.
But yeah, fair enough. I won't say I disagree with you. I mean, I think I do feel about it very similarly. So let me go through some quick questions here for you. The first one is, when you talk about the contributions of your paper, you said your paper should be of interest to scholars, regulators, and practitioners, which I think is a very honest assessment. And yet, as a taxpayer, I'm pissed, right? I mean, a lot of our listeners are not scholars, they're not regulators, and they're not practitioners. And yet, I suspect most of us are taxpayers, right? What do we take away from this? Are we just pissed and sharpening the pitchforks?
Yeah, I mean, we're supposed to vote with our feet, right? Isn't that the argument? So as taxpayers, and maybe that should be another comma in the contribution section, but the public in general should be aware of this regulation because it is taxpayer money, and I don't think it's being spent optimally. And, you know, if you're upset with a certain regulation, then you vote. And right now, it seems like people have been doing that to various extents.
Of all the determinants of the last election, the American Rescue Plan, I don't know, Mike. But no, big picture, I agree, though.
Yeah.
All right. If we were to try a scale of 1 to 10,
okay,
where 10 you're like happy and 1 you're ready to burn the world down, how happy, upset should I be about this if I'm Group A, a union member whose plan is directly affected that gets a bailout? Am I a 10?
You're not a 10 because I actually like your alternative story of straight cash.
Okay.
I think that's better. So you're not a 10, but you're probably an 8.
Okay.
Particularly for the retirees, it makes funding for 30 years, which is probably going to span the life of a lot of the retirees. And so your hard-earned money will be secure for the rest of your life.
So what about a union member of a plan that wasn't bailed out?
I would say you're still happy. I would say because you have a new government backstop. The PBGC is running out of money. Maybe your friends and colleagues have been worried about the security of their pension plan. And so it seems like there's new security that didn't exist before. And so I would put you not as an 8, but let's call it a 6.
Fair enough. What about a firm that has an MEPP? I'm the CEO of a firm that has a multi-employee pension plan.
I think they're the biggest winners. I would put them as a 10.
That's my sense too. And finally, taxpayers.
It didn't make you happy. Where are you on the scale, Veljko?
Oh, I'm sharpening the pitchforks. No, jokes aside, I thought it wasn't just the plan itself. When I was looking at the details of this plan, there was a lot that bothered me. And what bothers me more than anything is the bailout without the reform. And it's like, it's just really mindful of what happened with the bailouts of student loans, right?
Yes.
Let's just give a bit of cash for everybody, buy a bunch of votes, and not change absolutely anything, right?
What's frustrating about that, but it's certain people, right? It's not everybody. Union representation or people that went to college. And so it's selective bailouts, which are not fair.
I agree with you 100% on that point. Yet, there is also in the back of my head a small voice that keeps asking, is there a better alternative, right? And I also am sensitive to the narrative of there have been some mistakes made in the past. They're not necessarily the responsibility of the workers that are affected by them. And there is a little bit of humanity left in me, even after the PhD and all these research years, to say, well, maybe some people need some help, right? And, without taking away anything from your moral hazard findings, right? But perhaps there just isn't a better way of doing this, and we have to face some of the adverse consequences of moral hazard, right?
We're not running a switching regression where we can't see what would have happened if regulation was put together this way.
Sure.
I would have been curious to see what would have happened with the non-bailed out plans if a loan was required instead of just a cash infusion.
Okay. Yeah, I love that.
That would have been super cool. And your alternative explanation of straight cash to the retirees, I don't know if the firms would act the same way if it's a straight cash bailout, because the firm, I guess their liabilities are reduced anyways because you're providing a cash infusion. But I think a loan would be pretty interesting. Maybe you wouldn't be as aggressive.
I'm not sure. I mean, by the cash infusion, I meant a cash infusion to people. So I'm not sure that liability to the pension fund would be reduced. Yeah. One thing that strikes me is I found an article in Forbes, and this was actually talking about the central states bailout, which was almost like a third of the ARP altogether, right? And it's quite nasty in the details when you start looking at it, because again, that's the one I was not remembering earlier, right? The Hoffa affiliated one. And, okay. But what did strike me is an interview with somebody named, I can't find the first name, last name is Gottbaum, and he's the former director of the Pension Benefits Guaranteed Corporation. And he actually comments on the ARP by saying, what's worth noting, and I'm quoting him here, what's worth noting is that the bailouts create incentives for reform. And he says, this is essentially a 30-year fix. Any pension plan that thinks there's going to be another one in 30 years is kidding themselves. They know they have to get their houses in order. But it's actually interesting because he's not the only voice. If you actually read some of the regulatory documents, they're actually saying there is signal and shame, I guess, in receiving this bailout, which is going to create discipline. And I was just wondering, have you guys found these arguments on the other side of the spectrum that saying a bailout actually increases discipline? And I wish our listeners could see you. Your body language says everything about what you think about this argument, but any comments?
Yeah, to your point earlier, it's not a fix, it's a plug. Right.
Sure.
In 30 years, so the way that SFA works, these cash infusion, the amount of money you get as a bailed out firm only guarantees that you have enough money to pay out disbursements over the next 30 years. Beyond that, it's you're blank again. You're out of money.
30 years. 30 years is most people's professional lives, right?
That's right. But firms last forever, though. I shouldn't say that, but
sure.
If we do a discounted cash flow analysis...
I'm used to treating firms as perpetuities, and yet I also know that the incentives of managers are not always aligned with the incentives of firms, right? I get it from the point of view of the firm, 30 years is nothing, but from the point of view of any human-facing agency costs, 30 years is eternity.
And I think towards Josh's points, there are some restrictions within the regulation that restrains the ability of the plans that got bailed out it restrains their ability to invest aggressively. It restrains benefits, restrains administrative fees. But what we study are those that have revised expectations, right? And so we find that the incentive to gamble goes up for those recipients that have not yet received bailouts, which I don't think is good, to the extent that there's another huge financial crisis and the stock market tanks again, these plans are overinvested in equity, will be disproportionately hurt. And so maybe Josh is right that the next 30 years, these plans will be safe, but there's a lot of multi-employer pension plans out there, and a lot of them don't have enough assets to meet their future obligations at this point.
Many other countries in the world put everybody under the same pension system, right? And it seems to me like some of the issues here are from the fact that you're bailing out some workers, you're creating moral hazards for the ones that are not bailed out.
Yeah.
Right. One solution to this is let's bail out everybody. another solution to this is, should we just have a national pension system?
If you believe that things operated by the government are run more efficiently, then, maybe be an advocate of that. But I tend to be a Rochester free markets kind of guy. And so I don't know if that's the best sort of solution for these kind of problems.
Fair enough. And for full disclosure, I spent the last 20 years writing about government inefficiencies. But we are actually putting together another episode for Questions in Finance, which is going to deal with the more direct question of, was the shift from defined benefits to defined contributions a mistake, right? And without giving everything away, we do have at least some research finding that shift led to a lot of underfunding, right? And perhaps a little bit more risk. And any thoughts in regards, or is that too abstract from where your research is at?
Cliff Smith, who's a famous corporate finance professor out of Rochester, always said, sort of tongue-in-cheek, options have value. And so I think it's nice for when you started at Buffalo and I started at Buffalo, we had a choice between DB, defined benefit, defined contribution. I appreciate the choice. I went for a defined contribution plan because I like having things under my control. I also thought there was a low probability of me getting tenure and things work out. So it worked out. Did you choose DB or DC?
I also chose the defined contributions, which makes me a hypocrite, given that now I'm critical of the shift, right? And yet that's an interesting point. That's a good way to think about it, right? Okay, fair enough, Mike. Is there anything that we haven't touched upon that you were hoping to talk with us today?
No, I think you did a good job covering it. I also want to thank Kate for actually reading my paper. So good on you, Kate. But yeah, it was super fun to talk about pensions and our research.
Thank you very much, Mike. And by all means, it was fun for us as well, or fun for me. And we will rely our thanks to Kate, of course. I hope that one day you're going to come back and talk to us about some of the other very interesting research that you have. I have always been fascinated by your work on the Jobs Act. Right. But thank you very much for taking the time, for talking to us, and good luck with the publication process. We know how challenging that is. This is a great paper, but a little bit of luck always helps.
Thanks, buddy. I appreciate it.
Cheers.